All right, so this is the part two of my gold trading strategy. So the part one got over 100k views and it has been working really well for a lot of you people. And some of you guys had some questions, and I thought that I would make part two and explain things in more detail. So I'm gonna re-explain the strategy in this video, and you have to follow me like 100%. All right, whatever I say in this video, you have to follow it. I'm going to reveal everything, so there is nothing hidden. I'm not hiding anything for my course or for my mentorship. All right, this is 100% the entire information. Okay, now one thing that you need to realize is you're gonna have winning days and you can also have losing days. Okay, now the title says that it works every time, and now what I mean by this is that it's gonna work in the long run, right? So it's gonna work every week, right? It's gonna work every month, but there will be a day where you will lose, and that's totally normal with any strategy, guys. But this strategy, I you have to trust me on this. This strategy is one of my best and it has a very good win rate. Okay, if you follow step by step, you're gonna actually make around 8 to 10% per month. Okay, now sometimes it could be lower, around 5%, right, 4%, but most of the time you're gonna average at around 8 to 10%, and sometimes even more. It's all about your psychology, to be very honest. Okay, this strategy works, but if you're gonna try to add your own rules and do random stuff with the strategy, it's not going to work out. Just follow this. Okay, you do not need daily buys. However, if you implement it, it's going to increase the win rate. So at the end of this video, I'm going to teach you a secret daily buys technique that you can use with this strategy to make the win rate even higher. So what exactly was the strategy? So at 8 p.m. New York Times. So what you have to do is go here and then you have to choose New York Times, and so you don't have to worry about whatever timing I'm telling you in this video. Okay, so this is 8 p.m. open. Now before that, all you have to do is mark out the most recent high and most recent low. Okay, so a lot of people had this question: which high and which low should we mark out? Should we mark out the swing high or swing low, or any low or high, right? So the answer is any high and any low, the most recent that forms before 8 p.m. So let's assume that this line is 8 p.m. open. All right, I'm not talking about 8 a.m. I'm talking about 8 p.m. Remember that. That's when the Asian session starts. Okay, now you can see that, let me just do this. Okay. All right. So we have a recent high over here, right? And then we have the recent low. Okay. So I'm not worrying about the swing low or, the swing high over here. I'm marking out the most recent high and low. It doesn't have to be, significant highs and lows. Okay. Because what's going to happen is at the Asian Open, which is at around 8 p.m., right? Price is going to instantly purge any liquidity that is present below or above the current price action, right? So there's a high over here. So let's assume that we have marked out the most recent high and low on the 15-minute time frame. So this is very crucial. All you have to then do is wait for price to either take out the high or the low. So let's assume that the high is taken out right here, right? Now, simply what you have to do afterwards is you have to drop down to 1 minute time frame. This is very important. 1 minute time frame, look for a market structure shift. Now, remember this one thing. This is very important. Your entry should be before 10 p.m. Okay, so this right here is 8 p.m., which is gonna look like 20. All right. So for example, let me just show you how it's going to look like. This right here, look, the time below, right? It's 20. So that's basically 8 p.m. So this right here is 10 p.m., which is going to be 22, right? So our entry must be before this time period. That is very much. So in between in between 8 p.m. and 10 p.m. So as soon as you get the market structure shift, as soon as the candle closes below this low, you have to market enter. You have to enter the trade right away. Put your stop loss right above the high, or to account for the spreads, you can put it a bit higher, because if you are on prop firms, they will not allow you, some of them, to enter a gold position that has around above 10 lots, right? So you can just increase the stop until you get to like 10 lot stop loss, if that makes sense, right? Sorry, if you can use like 10 lots. I hope that makes sense. So you can just adjust your stop loss accordingly, and then you can enter the trade and go for 1 to 2, right? Go break even after 1-to-1 risk to reward ratio is hit, and you are basically taking out 80% of your profit at 1 to 2, and then you are holding till 1 to 5, and the rest of the 20% is gonna keep running until you hit 1 to 5. Okay, and that's going to maximize the profits. Now, similarly, if I flip the chart, the same rule applies. The price takes out the most recent low after 8 p.m. Then we drop down to 1 minute time frame, and then we look for a market structure shift with displacement. So the leg that makes the market structure shift must have a fair value gap inside it on the 1 minute time frame. And then you can literally just enter right away. However, if the market structure shift has gone way far up, right? What I suggest is you wait for price to come back into the discount or some form of fair value gap, because your stop loss is going to get bigger if you enter somewhere around here, right? So just be a little patient and look for that entry. It's really that simple, guys. Now, one thing that you can basically do to increase the win rate is use SMT divergence with DXY or silver. So for example, if gold makes a lower low, lower high, lower low, and on the silver we fail to create a lower low, then that shows that there was an SMT divergence, and afterwards if you get a market structure shift, that's going to confirm it even further that we're going to push towards higher, right? So that is the entire strategy. Now I'm going to give you guys some examples, and you have to watch them carefully because I'm going to provide a lot of more information in those examples, so make sure you do not skip the video. All right, guys, so here is example number 1, and that happened on 3rd July. So you can see that just around here, this is the 8 p.m. open right here. Okay, so before that, so this is the 8 p.m. open. Before that, we would simply want to mark out the most recent low and the most recent high, right? It's very simple, guys. There's no, extra science to it. You don't have to mark out this high or this low. No, the most recent, okay? I'm not going to repeat it again. So opening price, right? That's when the 8 p.m. candle opens. You can see we took out the most recent lows. If I drop down to the 1 minute time frame, you are going to see that what exactly happened here. So the low was taken out first. Now we are simply waiting for a market structure shift, and over here you can see we have a fractal shift in the structure. We broke this high, right? So you can simply just enter over here with this green candle, and your stop could somewhere be around here, okay, to deal with the spreads. It's totally okay. You don't have to put your stop over here, okay? Just don't do it. Just keep your stop somewhere nice like here to deal with the spreads or to deal with the prop firm issues. And then you can see that you could have taken like 80% over here, and then you could have held for 1 to 1.5. I'm not sure if it went to 1 to 1.5, but then you are gonna be at break even. But yeah, eventually you can see that it went for 1 to 1.5. So now let's move on to the next example. All right, guys, so here is example number 2, and you can see that at 7:59 p.m. I'm gonna mark out the most recent low and the most recent high. Okay, that's all. Then you can see price takes out the most recent high. So what I'm gonna do is I'm just gonna drop down to 1 minute time frame, and I'm going to look for a market structure shift. So let's see. If this low breaks, then I'm going to look for my entry. And right here we have our break in the structure, or a market structure shift. Short position right here, stop right above the high, right? It's a decent stop loss. And simply 1 to 2. And you're gonna see that price just goes down, right? Hits the take profit. So 80% of the position closed here. And then you can hold, but this is just for bonus profits, okay? Price can actually go and stop you out at break even. But the original target, the main target, is 1 to 2. So you can see that the bonus was not attained. You just closed most of your position at 1 to 2. So that is a perfect win. Now let's move on to another example. Alright guys, so here is the last example. As you can see, I have marked out the most recent high and the most recent low at 7:59 p.m. So now I'm gonna wait for price to take out the high or low. So in this case, the high was taken out. I'm gonna simply drop down to 1 minute time frame, and I'm gonna look for a shift in the market structure, right? And you can see that we failed to close below this low over here. So that is not a valid shift in the structure. However, you're gonna see that just around, so we keep going up, right? And if I play this through, you're gonna see that just around here we got a shift, and we also broke this structure around here. And our entry, remember, it must be before 10 p.m. right? So now I cannot simply enter here. Why? Because this move is way big and my stop loss is going to be huge. So what I'm going to do, I'm going to utilize this fair value gap that is not mitigated, right? And there's a volume imbalance here as well. So this is going to be my short position. My stop will always go above the high, and I will simply aim for 1 to 2 and take like 80% of my profits there. So you can see we got our entry, 80% profit done, and you can see that the price keeps going down, giving us 1 to 5 risk to reward ratio. So you can see how clean this trade was. This was a beautiful, you have to make sure that you consider market structure shift with a body closure, okay? Because we are on a 1 minute time frame, and that's going to confirm that the market structure shift is an actual shift, right? So now what I'm going to do is I'm going to teach you a daily bias technique that you can use with this strategy. So if you go to the daily time frame here, so all you need to do here is, let's assume that this is a bullish candle, right? So let's assume that the next candle closes above this bullish candle. So now your bias would be bullish, right? Until this high is taken out, right? So let's assume the bullish candle was here and the next candle. So let me just go to the replay mode to explain it in detail, okay? Because otherwise you would get confused. So let's assume this is a daily candle. And on the next day, we closed above the previous bullish candle. Now, our bias would be bullish for the third day. So this is the first day, this is the second day, and for the third day, this is going to be the opening price of the third day. Our draw on liquidity is going to be the high of the second day. So now on the third day, your bias would be bullish. So as you can see, we again closed above the daily high. So now you can see, since we closed above the previous bullish candle, the next day is going to be bullish. And you can see that this was a bullish move to the upside, right? And then once again, we closed above the bullish candle. So the next day, right, is going to be bullish. So as you can see, we took out this high over here, and once again we have a closure above this candle, so we're going to be bullish. And you can see once again we took out this high. So now we have closed once again above the previous bullish candle, right? So now our bias would be bullish for the next day. So the next day opens around here, and you can see the next day was bullish and we took out this high. And this time we failed to close above the previous bullish candle. So we're going to wait and see what happens. So you can see that we basically closed below this bullish candle. So now you're going to see that we need at least two candles. So we had one candle. If we had another bearish candle that broke this low, then I would consider the third candle to be bearish. But since we closed above this candle right here, you're going to see that we had a bullish day and price pushed up once again. So this is a technique that you can use if a daily candle closes above the previous day's candle, then the third day is going to be bullish, and vice versa for shorts. So I really hope you guys enjoyed the part 2. This is the entire model. If you are interested to learn more, my new course is coming out in just a couple of days. And if you join my first course right now, you will get the new course for absolutely free. So this is a limited time offer. And if you are interested, it's not necessary, but the link is in the description. I'll see you guys in a few days. Goodbye.